Today, property signs for the 14th of June 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. In today's show, we examine the latest and fading consumer confidence measures, rising default risks among SMEs, and the easing of lumber futures prices, which may suggest structural inflation expectations are overblown. And this post is supported by Ribbon Property Consultants. Housing-related consumer sentiment has plummeted by 27% since November 2020 and is in pessimistic territory for the first time since April 2020, according to the latest report from the Westpac Melbourne Institute. The index for June 2021 has revealed that housing-related sentiment has continued to show significant signs of stress, with the time to buy a dwelling index declining for the fifth consecutive month. The index dropped by 7.1% in June, 10.7% in the last year, and is 27% below its November level, according to Westpac. Westpac's chief economist Bill Evans said at 96.1 the index is now in outright pessimistic territory for the first time since April last year, and prior to that, late 2017, when housing was entering a difficult period marked by slowing activity and falling prices, particularly in Sydney and Melbourne. Victoria recorded the largest slump in buyer sentiment. That, of course, is amid a fourth snap lockdown to contain the spread of the coronavirus pandemic, with the index dropping by 11% in the month, 20% in May, and 24% over the past 2 months, according to their research. Property price expectations have shown also signs of decline, although consumers have remained very bullish on the house price outlook, Mr. Evans said. The House Price Expectations Index declined by 3.6% in June, but remained in strongly positive territory at 157. Consumers were also asked additional questions about where they see the wisest place for their savings. The research showed that where consumers are a little more open to risk, only 9.5% of consumers nominated real estate as a savings option, up from 9.3% over the past 3 months. And Evans noted that this has continued the run of very low reads seen for real estate over the past year, with a long-run average of 25.9%. This result might seem at odds with our expectations that investors will assume a dominant role in the current surge in housing activity, he said. While real estate is still not viewed favourably, bullish price expectations will be enough of a draw card for many investors. The extent to which we see a wider shift in sentiment towards the asset class remains a key uncertainty. The proportion of consumers who favour shares has risen from 10.5% to 12.1% over the past 3 months, while safe options such as bank deposits at 29% and to pay down debt, 19%, have continued to remain popular among respondents, comparable to the average reads in the years following the global financial crisis, according to the index. And Evans has predicted that financial conditions would gradually tighten, anticipating that the Reserve Bank of Australia will not extend the yield curve targeting policy from the April 2024 to the November 2024 bond, and that means that we've passed on the opportunity to reverse the gradual tightening in fixed rates that has occurred since late 2020, he said. When assessed in conjunction with the withdrawal of the Term Funding Facility, although banks have still around $64 billion to draw down by the end of the month, the clear signal is that financial conditions are likely to tighten. The overall Westpac Melbourne Institute Index of Consumer Sentiment tumbled by 5.2% in June, which Mr. Evans attributed largely to concerns around the 2-week lockdown in Melbourne. The survey, of course, was conducted during the first week of that lockdown. And the index has returned to January levels when there were significant lockdowns in parts of Sydney and Queensland. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Rubin Property Consultants standing alongside you. Buying property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high. Price discovery and price transparency are hard to find. And then, of course, there is the wasted time and financial investments that you have to make. Edwin understands your needs. So why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Rubin an email at info@rubinproperty.com.au, and if you use the promo code DFAWTW/Martin, you can receive a 10% discount offer. Now, after months of positive economic news, there are now signs that Australia's economic recovery may have hit a snag, with results for the May Creditor Watch Business Risk Review suggesting the economic recovery is losing some momentum. According to the proprietary analysis Creditor Watch conducts each month for its business risk review, credit defaults increased by 9% against the 3 months to February this year, and external administrations rose by 24% over the last 3 months. Creditor Watch data is among the first to reveal that SMEs may be starting to struggle more in a post-JobKeeper environment than was expected earlier in the year. It's not all doom and gloom, though. These figures are to be expected as Australia's economy starts to return to a normal level of activity. Since April last year, defaults have remained 50% lower than pre-pandemic figures, largely due to government stimulus support. The focus now will be on the next steps to get these numbers back on track to pre-pandemic levels. We've been saying for some time we won't be able to get a true picture of the economic health of the nation until federal government stimulus measures such as JobKeeper have ended and their impact has stopped artificially propping up some businesses, said Patrick Conlon, the CEO of Creditor Watch. Early signs from the Business Risk Review suggest that there will be a shakeout of poorly performing businesses over the coming 2 quarters. The May 21 Creditor Watch Business Risk Review is one of the first red flags in that regard. He said, "It's not difficult to find good economic news for May 21, such as credit inquiries, but the metrics behind that message appears to be losing momentum," said Creditor Watch Chief Economist Harley Dale. The Reserve Bank of Australia's statement for its June monetary policy decision indicated the bank is expecting extremely healthy economic growth of around 4.75% this year and dropping to a GDP growth of 3.5% in 2022. The unemployment rate is sitting at a relatively benign 5.5%, a figure that is expected to fall to 5% at the end of this year. Now, one dull spot was a 0.3% drop in company profits following the end of federal government COVID stimulus measures. The question is whether this is a harbinger of future negative news to come. Now, it's encouraging, they said, to see that the number of credit inquiries has risen on an annual basis for 8 months straight. The number of inquiries was 36% higher than a year earlier, a very encouraging result for business investment. But credit defaults trend south on recent numbers. Credit defaults are 43% lower over the 3 months to May 21 compared to the same period last year. That's a great result. Yet, on the 3 monthly comparisons, defaults are up 9% since the 3 months to February this year. Short-term external administration figures also show a turn for the worse. The number of external administrations fell by 6.5% in May 21 compared to a year earlier and were down by 17% over the 3 months to May 21 compared to the same period last year. But the sting in the tail is that administrations are up by 24% over the past 3 months, and overall the May Creditor Watch Business Risk Review is a mixed bag. Annual figures are an improvement on this time last year, which is to be expected given we were only just emerging from the first of the serious pandemic lockdowns in mid-2020. But the more recent numbers suggest a weakening economy post-JobKeeper. Only time will tell, they say, how long this recent fragility is likely to last. And talking of fragility, lumber futures prices posted their biggest ever weekly loss, extending a tumble from all-time highs reached last month as sawmills ramp up output and buyers hold off on purchases. Prices in Chicago fell 18% this week, the biggest decline for most active futures in records going right back to 1986. Lumber has now dropped almost 40% from the record high reached on May the 10th. Sawmills appear to be catching up with the rampant home-building demand in North America that fueled a month-long rally, bringing some relief to a market beset by supplier shortages and price surges. Buyers are bulking at still historically elevated prices and awaiting additional supplies, setting off a cascading sell-off, analysts said. Activity yesterday was brisk to start turning lethargic and ended quite subdued. William Gurji, who buys and sells eastern spruce with mills for Sherwood Lumber in Massachusetts, said in the note on Friday, there was plenty of lumber available from the mills and enough ambition to sell. Missing was the sense of urgency from buyers. Many buyers only purchased if necessary, generally staying on the sidelines, CIBC analyst Hamir Patel said on Friday, citing an assessment from Random Lengths. The closely watched trade publication reported further declines in several wood products that trade on the cash market and pointed to an abundance of mill offerings, Patel said. US lumber production has responded to the price rally by ramping up output by 5% over the past 12 months, and another expected increase of 5%, or roughly 1 billion board feet, according to Domain Timber Advisory, a subsidiary of Domain Capital Group in Atlanta. Resolute Forest Products is spending $50 million to increase its lumber production, the timber said on Thursday. And West Fraser Timber Co., the world's biggest producer, said recently that it's expanding capacity at 5 US mills, while rival Canfor Corp has said it will invest around $160 million in new sawmills in Louisiana. Still, while lumber prices may finally be pulling back from stratospheric highs, don't look for a return to pre-pandemic levels anytime soon, according to BMO Capital Markets. Nosebleed prices won't last, but strong demand, a limited supply response, and a rising cost curve all point to above-trend prices for at least the next 12 to 24 months. BMO analyst Mark Weil said in the note, lumber futures slid 5.6% in Chicago to $1,059 per 1,000 board feet on Friday, and prior to the rally that started in mid-2020, lumber futures traded mostly within the range of $200 to $600 since 1992. With strong US home building expected to last for several years, lumber prices will likely remain above $500 per 1,000 board feet for the next 5 to 8 years, said Scott Reeves, Forest Operations Director at Domain Timber Advisors. We're at a new normal, Reeves said in a phone interview. We're going to see this sustained level of housing demand and a new normal for the pricing floor in lumber. Well, if that lumber story is true, then maybe the Fed is correct, and a lot of the inflationary pressures that we've been seeing are just due to supply chain disruptions. But again, there are a number of conflicting signals, both looking here and over in the US, that suggests that things may not be as economically strong as some of the headlines actually suggest. And those forward indicators relating to housing expectations here in Australia could mean that prices will cease to grow so quickly. And of course, not all prices have been growing that fast in any case, particularly in the rather gloomy apartment sector. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.